Swing Master Chartist is divided into two major charting sections, analysis charts and campaign charts. And the reason that we did that is to answer two essential questions about swing trading and what you do with those answers. The first and most basic question is, what is the direction of the trend right now? Now, if your schedule doesn't permit you to review charts during the day, then you should probably determine trend off of daily charts. If you are able to review charts during the day, then you may want to determine trend from 130-minute charts, which is what we're going to use in this video. Now, the trend can be either bullish, bearish, transitioning, or just plain old sometimes don't know. The first thing you want to do before you even start is you want to get the latest intraday data. And you use Yahoo Intraday or Google Intraday. And we just did this, so the data is fairly recent. And you want to create 65-minute and 130-minute minute bar charts because that's what we're going to use for the analysis. But we pulled up the 130-minute data, and you want to use the slider at the bottom of the screen to fill most of the screen with the last clearly defined swing. Now we're going to use our trend finding tools, and the first tool we're going to use is from the overlays menu, and that's the Keltner Channels. Now, Keltner Channels are like Bollinger Bands, but instead of using standard deviation for volatility, the Keltner Channels use average true range. I prefer the Keltner Channels because you get a clearer picture of what's going on with the chart. Now, here's a quick lesson on Keltner Channels. In this chart, you can see a bear swing on the left side of the screen and a bull swing on the right side of the screen. In a bear swing, the prices tend to stay between the center line and the lower channel bounds. And in a bull swing, they tend to stay between the center line and the upper channel bounds. And we don't attach any special significance when price bars pierce either the upper or the lower channel bounds. Now, you can call these upper and lower channel bounds the bull lane and the bear lane, just to add maybe a little clarity. But you can say the trend is transitioning when the price bars change lanes. In this case, they change from the bear lane to the bull lane, and the most recent few bars indicate that the trend may be transitioning because the bars have switched from the bull lane to the bear lane. Now, the next tool we're going to use is from the context menu, and to get that, you right-click anywhere on the chart and click Trend Stoppers. Now you see two dashed lines. The red dashed line is always 2.5 average true range from the 15-bar low, and the green line is always 2.5 average true range down from the 15-bar high. Now in this chart, we can say that the bull trend is busted because the price bars have cleared the green trend stopper line. Now the third tool we use is the Vortex Trend Indicator, and that's on the indicator menu. And the way you use the Vortex Trend Indicator is that when the green line is above the zero line, which for this indicator is actually set at 1, and the red line is below the zero line, the trend is bullish. And conversely, when the red line is above the zero line and the green line is below the zero line, the trend is bearish. Now, we just had a crossover. The red line is showing it's at 1.11, and the green line is, well, still at 1.01, not quite below zero. So based on the vortex trend indicator, we have to show that the trend is transitioning and appears to be heading bearish. So we just put up a 130-minute chart, and we used only 3 indicators, and let's review what we could learn from them. The Keltner channels show a transition, or at least a possible transition, from bull to bear. The trend stoppers show us that at a minimum the bull trend is busted because the price bars are trading below the green dashed line, and the vortex indicator is showing a transition and possibly the start of a bear trend. So the takeaway we can get from just these 3 quick indicators is that the bull trend has likely ended, and that it's equally as likely, if not more so, that the trend is transitioning from bull to bear. So we've answered the first question: what is the direction of the trend? Now, that's important and useful information, but we know that it has a very short shelf life, and we can only say that the trend is transitioning from bull to bear for this ticker right now. Now, the second part of this video, we're going to cover what we can do with that information if we're prepared to act right now. This is a campaign chart of 65-minute S&P 500 data. Now, the 65-minute charts work well for swing trading because they provide early entry signals, which helps to reduce the risk of any trade. And they hold up for swings that can last for several days without getting frequent whipsaws. So let's review the basic elements of the campaign chart. First of all, the campaign chart shows about 140 bars of data for any time frame. That's fixed and that cannot be changed. These 3 moving averages, the blue, the red, and the green, are called the breakout bands, and their main function is to show you when the price bars are in a congestion zone and going nowhere, and when they break out of a congestion zone, and at exactly what price they will break out of the congestion zone. And the most basic rule of our swing trading method is that you only want to enter a trade when price has already broken clear of the breakout bands. Because once they're broken clear of the breakout bands, the probability is higher that they will continue in the direction while staying clear of the breakout bands. And you can see the best example is on the far left side of the chart, where prices broke out and continued on this several bar run, which would have been a fairly good swing trade. Now, the other thing we want to show you are the breakout prices, and they're available from the context menu. Just right click for the context menu and select breakout prices. And the breakout prices tell you at exactly what price level you want to be watching to see where the breakout will occur. And the first opportunity for a short trade on this chart occurred at the price 1 tick below 1867.16. And here's the key element. If we put the bar here, we can see that prices broke out clear of the breakout bands and traveled and closed on the 65-minute chart below the breakout price. That was the sell signal for this 65-minute chart. The second opportunity occurred at 1 tick below 1854.38, when prices rallied for a few bars back into the breakout bands and then broke down again, clearing the 1854.38 price level. So we've had two valid sell signals on this chart since the top at 1833, or since the top at 1882.35. Now, the initial stop, if you had taken the trade that broke through the 1867.16 level, would have been the high at 1882.35, or one tick above. And the stop, if you took this trade below 1854.38, would be at its maximum point, the high at 1874.40, so one tick above that. But you can also use other tools for your sell stops. You can use the green breakout line, the red breakout line, or the blue breakout line, depending on the volatility of the instrument you're trading. And we've also added Parabolic Sar, which is a well-used tool for placing stops. And the Parabolic Sar is probably the most aggressive stop tool because it places them very close to the market. So in this case, had you taken the trade that busted below the 1854.38, your parabolic stop would be, and you can read it at the bottom of this data point, 1860.77. So you can also use the Parabolic Sar as a stop signal. Now, the only other thing we want to show you in this particular video is one more tool, and that is the Stochastic Rsi. Now, Stochastic Rsi is an oscillator. It measures the level of RSI, not the price bars, relative to the high-low range of the RSI over a certain time period. And Stochastic Rsi is useful in that it increases the sensitivity of the RSI to generate more overbought and oversold signals. Now, these are short-term signals, but they're still useful. And let's look at both of these examples. The first breakout price was the 1867.16. And we can see that at that point, at least, the Stochastic RSI was in an oversold condition. Now, when the breakout occurred, or immediately prior to the breakout, we can see that the Stochastic RSI was in a very overbought condition, which is ideal for a short trade setup. And we'll just follow over to the last breakout point, and we can see that immediately preceding the breakout point that the Stochastic RSI was in an oversold condition. So basically, you don't want to be going short when the RSI or Stochastic RSI has been dragging itself along the oversold condition, nor do you want to be going long when the Stochastic RSI is pumping through and hanging around the overbought condition. Now, these peaks and valleys only last for a very short time, so you have to be paying attention, but that's a good secondary input that may keep you out of a bad trade. Now, in this particular SP 565 chart, we just came from the SP 500 130-minute charts showing a transition to a bear trend. And as far as this chart is concerned, we're actually a couple bars late because we missed the breakout below 1854. And we have the Stochastic RSI is now at a low level. So statistically, it probably would not be a good time to enter a trade. I haven't looked at the market. The S&P may be down 50 points right now. I don't know. But just statistically, you want to wait for a little pullback, not back above the breakout bands, but a little pullback, maybe back into the breakout bands, but below the blue, and for Stochastic RSI to climb back up toward the top for the next great setup. Okay, so we've covered how to determine the trend using 130-minute bars, and we just quickly went over some of the basic tools you can use for trade setups in the campaign chart. We'll continue to develop both of those facets of Swing Master Chartist, the analysis chart and the campaign chart, and particularly go into more detail on the campaign chart because there's just a wealth of information hidden in here. But even with the basics, I think you've got enough information that you could improve your trading just with the bare information that you've received and act objectively and keep your risks at a manageable level. I hope you've found this useful.